welcome to Market Structure 101. My name is Christian Barrero. I am the founder of Good Eats FX LLC. And in this book, I'm going to teach you how to use market structure to learn how to trade. Here's a table of contents. There's going to be 6 major chapters that we're going to focus on outside of the introduction to market structure and my final thoughts. We're going to keep it very simple and straightforward and progressive so that every chapter builds on the previous chapter. So you've made it to Market Structure 101. If you're new to trading, one of the most important skills you're going to be able to develop is learning how to read a chart. Before you can build a trading strategy, you have to be able to identify opportunities, make decisions in the market, and understand what price is actually doing. So the purpose of this book is to teach you exactly that. It's the foundation of chart reading through market structure. We'll cover trends, candlesticks, swing points, market conditions, structure shifts, and do it all in a simple and straightforward way. My goal is not to overwhelm you with complicated terminology. My goal is to help you look at the chart clearly and understand what price is doing. Once you can do that consistently, everything else is going to become much easier. So remember, every chart is going to tell a story. Market structure is simply learning how to read it. So what is market structure? Simply put, it's the study of how price moves. Every move in the market is going to create a pattern that traders can use to better understand what is happening. So by setting the patterns, we can identify whether the market is moving higher, moving lower, or moving sideways. Why does market structure matter? Well, before entering a trade, you're going to need to know what condition the market is currently in. So you have to be able to identify trends. You're going to identify consolidation, recognize changing conditions, and you need to build confidence in your decision making. If you can't identify the current market condition, it's going to become difficult to develop a consistent trading plan. The first thing we're going to focus on is going to be, what is an uptrend? An uptrend is a market trend that is moving higher, and that's going to consist of higher highs and higher lows. It'll look something like this. So all the lows are higher than the previous lows. All the highs are higher than the previous highs. What is a downtrend? And it's going to be the complete opposite. A downtrend is a market that is moving lower. It's going to consist of highs that move lower and lows that move lower. It'll look something like this. If you look at all the highs, they're getting lower, and all the lows are getting lower. Consolidation is when price moves sideways. It's not making any strong moves up or down. And it would look something like this. Price will make a movement from a low to a high in this example. And then we start to see a low that's higher than the previous low, a high that is lower than the previous high. And what you see is you're just jigsawing between lower lows, lower highs, higher lows. There's no clear indication. You're stuck in a box. And this is what a consolidation is. Okay, let's move on to actual candlesticks. And the first one that we're going to focus on are bullish candles. So here's some information and key takeaways that you can study. Bullish candle closes higher than it opens. The body shows the distance between the open and close. The upper wick is going to show the highest price traded. The lower wick is going to show the lowest price traded. The body of the candle, which is this green candle in this case, is what makes the candle bullish. And then the open, high, low, close bar on the right displays the same information as the candle, but in a different format. So a bearish candle closes lower than it opens. That's what makes it a bearish candle versus a bullish candle. Opening up here on the top and closing on the bottom. There's the body distance between the open and close. You have the upper wick here showing how price traded to this highest point. And then you have the lower wick showing the lowest price point traded. And then the body of the candle, right? We already explained that that is what makes it bearish from open down to close. And then we have the open, high, low, close bars showcasing the same information, but without the candle. Okay, let's move on. We're going to now connect the candles. And I'm going to explain to you one of the most important things you will learn in this book, and that is swing points. A swing high is going to be a group of 3 candles where the middle candle's high is higher than the highs of the candles on both sides. Okay, so here's candle one. And we do not care if the candle is a bullish candle or bearish candle in this example. We're just focusing on the highs of the candle. Okay, the highest point of the candle, the wick high. This is candle one. Okay, this is candle two. Notice with candle two that the high of the wick is higher than the previous candle's high. And then you have candle three, which the high of this candle is lower than the middle candle. And that's what makes a swing high. One important thing that I want you to remember about swing points is that a swing point is only confirmed once candle three officially closes. You can't determine them until the time allotted for each candle closes, and we'll talk about time later on. For now, let's talk about what creates a swing low. The middle candle's low is going to be lower than the lows of the candles on both sides. So here's candle one. I want you to focus on the lows, okay? Because we're talking about a swing low. Here's candle two. And you can already see that the candle two is lower than the low of candle one. Then you have candle three is higher than the low of candle two. So there you have it. Lower low compared to the candle one being higher and candle three being higher than candle two. Okay, let's move on. Now, once we understand what a swing point is, we need to identify swing points. So here we have a swing high that forms when the middle candle's high is higher than the highs of the candles on both sides, right? So this is a swing high. Price continues to move in the direction. Price failed to create a new high and forms a lower high. This is the first sign that a downtrend is developing. We now see something really, really important happen. We have our swing high. We have our lower high to the previous high. And then price creates a swing low. Can you see that the range between the swing high and swing low is created? And now price is trading between these two swing points, between this high and this low. This is the first low created. This swing low has a candle number two is lower than candle one and candle three. And then price continues to move this direction. So what do we want to focus on next? Let's see what price prints. Now, I want you to focus on this lower high here and look at what price did as it traded above that lower high. If the trend is moving lower, for us to continue a downtrend, we have to remember that a downtrend consists of lower highs and lower lows. So anytime that a downtrend creates a higher high, the expectation should be we want them to immediately make a lower low. Yep. Okay, let's go to another example. So as you can see, the only swing point that is formed is a swing low. Then, after a swing low forms, immediately a swing high forms. And then price creates a higher low than the previous swing low. So what's starting to happen here is that this is the first sign of a bullish uptrend being created. Let's see what else price prints after that. So now, not only do we have our swing low, we have a high that was traded above after this higher low, creating a higher high and a higher low, right? So we have now created a range between this swing low and now swing high. Look at all of this up movement, low, higher low, higher high, higher low, higher high, swing high, right? So now it's very clear that we have a range of opportunity. Price is now trading between these 2 points. Okay, now let's see what happens after that. Now, I want to bring your attention to this very last higher low that was created right here. you can see that price traded below it. Now, remember what I said before in the previous example about bearish trends. We're going to say the same thing, but for bullish trends. For a bullish trend to continue being bullish, we need to see a higher low and a higher high consistently form. Anytime we make a lower low for it to be a continuing bullish trend, we need to trade higher than this. So, simply put, this becomes a key low because we're putting our attention on it. Price trading below the previous swing point and quickly moving back above, that shows respect to the bullish trend. So now that we've talked about identifying swing points, we need to connect these swing points. And this is going to help you to identify the market structure by drawing lines from swing high to swing low and swing low to swing high. You're going to be able to see the trend and consolidations and the potential reversal areas more clearly. So from A to B, we're connecting that this is one price movement. We make a swing point here. Now, what we want to see for the trend to be identified is what direction do we go from C to D? You can see here that we trade higher. So the trend that we're connecting from A to B is one price movement. From B to C is another retracement pulling back, right? We're actually creating that higher low, right? And then we have a continuation of the bullish trend, a higher high being created. So this is really cool when you connect the swing points. You actually learn to read the market and detect the direction of the trend. Okay, and then from D, we see here that we go to letter E. Okay, so I think this is a pretty neat thing to look at. When you start connecting ranges, you're able to identify the market structure. And you can see here in this example that this is an uptrend, simply because it's creating highs, higher lows, higher highs, higher lows, higher highs. Now that we've talked about connecting swing points, we need to determine trend from candles. Before determining trend, we need to mark the significant swing highs and lows. And we have to ask ourselves 4 questions. Are highs moving higher? Are lows moving higher? Or are highs moving lower? And are lows moving lower? Okay, you have to ask those questions while you're reading a chart, because if the market condition is going to be an uptrend, you're going to have higher highs and higher lows. If it's going to be a downtrend, you're going to have lower highs and lower lows. If it's going to be a consolidation, you're going to have a mix up of both, equal highs, equal lows. It will not be a moving pattern. It will be stuck in a range sideways. So here's a little visual of what the 3 different types of markets conditions you're going to be seeing. And I marked everything clearly so you can see the higher lows here, the higher high, higher low, higher high, downtrend, lower low, lower high, lower low, lower high, and then of course sideways, no movement. This will be something good to print out and have next to you as you're beginning to learn how to read market structure. And you'll be able to remind yourself as you mix up words, and sometimes you'll be thinking of a downtrend but saying uptrend terminology. So just practice it, have it here for you, and you'll be able to determine trend from the candles. Reading market conditions. Is price trending up is the question. We know that an uptrend is a market that's moving higher. We're expecting those highs to move higher and those lows to move higher as well. So here we have price moving from this point to this point. Okay. This point to this point. Now, this is our first higher low indicated here. Okay. And now we trade above that, and you can see the trend creating higher lows and higher highs. So it's important that not only you see it in a line graph, but that you also see it with candles, because the key takeaway here is that for an uptrend to be consistent, we have to see higher lows and higher highs. And each swing point is going to create those areas where we stop and then decide, are we going to go higher or are we going to go lower? Are we going to hang out here for a little while and consolidate? Let's move on to the next slide. So the big question here is price trending downward. Here's a little reminder that a downtrend is a market that is moving lower. We want to see highs move lower and lows move lower as well. So here's the first movement, right? We have price from here to here and then here, and that high is lower than this high. Okay, and then we want to see price trade lower and create a swing point. You see how we created a swing point here? And there's your lower low. Okay, and then you have your lower high, your lower low, your lower high, your lower low, and so forth. This is proving to be a downtrend. Is price consolidating? Are we moving sideways? Price not making any strong moves up or down? That's what a consolidation is. I have to say this twice because the truth is most people don't realize they're in a consolidation until they've sat there for about 10-15 minutes and noticed that the market hasn't decided what direction it's going in. That's why I put it in twice, just to remind you, consolidations are something that you have to focus to see quickly. So we have an important low and high in this example. We're calling that our connecting range. We've connected this low to this high. Okay. Then we have a higher low, lower high, a lower low, high, a low, a high. So you could have already detected at this point that we're moving sideways. It's understandable at this point to say, oh, we're still potentially going to trade higher, right? And even here, you can still say, hey, maybe we're going to trade higher. But at this point, now you're starting to question, wait, we're not getting above any of these highs, and we're not really getting below these lows. So, like, you don't have to wait another 10 minutes to realize that. You need to say, hey, sideways movement. This is a consolidation. Price not making strong moves up or down. It's just moving sideways. And here's the labels. Here's the box. And I wanted to show a real market example of how price moves from different conditions. So here we have an uptrend. You can clearly see from low, we make high, higher low, higher high, higher low, higher high. It's very clearly going upward. And then at some point, we get a consolidation. We have a sideways movement. And then we see a pretty quick drop off. Like not only did it make a low, it made a lower high, and it just started pushing very quickly. And this is what's going to happen in the real market, is that things happen a little bit faster than these slide examples that I'm showing you. These conditions happen sometimes pretty quickly, sometimes over a long period of time. It just depends where you're viewing the market from. This is another great one to print out, have by your desk whenever you are trying to study and remember things while you're in the live markets. So the next thing I'm going to teach you, and the final thing in this book, is going to be what is a market structure shift. It's a change in price delivery. It means that market is no longer respecting the previous trend, and it may be transitioning into a new phase. In this example, I'm going to be showing you a bullish reversal market structure shift. And this is the first type of reversal market structure shift I'll show you. So first thing you need to think of is that the market is in a downtrend, making lower highs and lower lows. The second thing we're going to say is price is going to create a lower low. Now, number 3 is the most important. Price will trade above the swing high that just caused the lower low. That is when we deliver a bullish shift. So it's lower low plus break above swing high. That is what creates a bullish reversal market structure shift. Don't worry, we're going to get into some examples right after this, but let me show you what the second type of market structure shift there is. A continuation market structure shift, which is basically a failed swing followed by a shift in structure. So we'll use another bullish example. The market is bullish now, making higher lows and higher highs. Price then fails to create a lower low. A failed swing forms. Price creates a higher high and then shifts bullish and continues the bullish trend. So failed swing meaning it did not go lower. It just continued to make higher highs. That is what makes it a continuation swing. And when I show you an example, you're going to see how it looks. Okay, let's talk about reversal market structure shifts. we're going to go through a bullish example and a bearish one. So price is going to be in a downtrend. We're going to see it make that lower low. Okay. So from this swing high, we're going to see it make it the lower low, lower high, lower low, and then immediately trade above that last swing point. That rally above the swing high that caused the lower low, that is what confirms that delivery has shifted bullish. Here is a bearish example. Price is in an uptrend, making highs, higher lows, higher highs, higher low, right? Well, this low traded below this one and then immediately made a higher high. And then what happened here? Price drops off. And if we just go down the order of importance, we're in an uptrend. Price makes the higher high, then trades below the swing low after making the high. Delivery shifted bearish. So you see that? Trades above the high and then immediately below the low. So it's these two levels that we're focusing on that confirms the bearish shift. So we have price creating a swing high. All right. Once that swing high forms, we can see that the middle candle's high is higher than the highs of the candles on both sides. Okay. We get a little bit more information. We see that price is clearly in a downtrend. Why? We have a swing high. We have a lower low. We have a lower high here, a lower low, a lower high. Okay. So we can see that this is a downtrend in development after the first example. Now we have this swing high, followed by a lower low, lower high, lower low, lower high, swing low. Now I want to bring your attention to the fact that we have created a range, all this information, right? I want to bring your attention to this lower high here. We trade above it after creating a lower low. And then we failed to trade lower. All of a sudden, a trend is no longer trading in one direction and it will just completely shift its delivery to the opposite side. And you can see that when this lower high creates a low and then a higher high, for it to be bearish, it would have to trade all the way down to this low, and it didn't. So it failed to do so and then trades higher. That is your bullish reversal market structure shift. Let's talk about continuation market structure shifts. So the formula is a failed swing plus a structure shift, and then that's going to be your continuation. Okay. Here is a visual example of what a bullish continuation shift looks like. Price fails to make a lower low, then rallies and creates a higher high. So look at number one, swing low created. Market is bullish, making higher lows and higher highs. Right? Look at point number two. Price pulls back but fails to make a lower low. All right. Look at now point 3 and 4. Price rallies, creates a higher high, breaks above the swing high prior to the failed swing. And then we have a confirmed bullish continuation shift. Simply put, your continuation shifts are going to confirm that we're still following that trend. Okay. Here's a bearish example. Starting from the swing high to swing low, we see market is bearish, making lower highs and lower lows. Looking at point 2, price rallies, but fails to make a higher high. Right? And look at point 2 to 3. Price sells off and creates a lower low. And if you look at point 4, price breaks below the swing low prior to the failed swing. Delivery shifts bearish and continuation lower becomes likely. So we're expecting the bearish trend. So continuation shifts are just trend trading. You're just going to see a little bit of differences when you look at candles versus a line graph. So let's do that now. So here we have price creating a swing high. All right. And you can see that the middle candle's high is higher than the highs of the candles on both sides. Okay. Then we start to see a trend establish. We have our swing high, our lower low, our lower high, lower low, and so forth. Okay. Price is failing to create new highs and forms a lower high. First sign that the downtrend is continuing. You see that from visual 1 to visual 2, right? We don't see any sort of up movement, just staying lower prices, lower delivery. Next, we have more of a development here, right? We have a swing high, a lower low, lower high, lower low. Okay, we just ran through that. And then after we trade above that lower high, look what happens here. We have a higher high. So for the trend to continue, what we need to see is for this high right here to trade lower. So anytime that you see a lower high traded above in a bearish shift, it makes a higher high. You want to see a lower low be created. That is what a continuation market structure shift is for a bearish example. So we've made it through market structure 101. Here's some things that we talked about: swing highs and lows being the foundation of market structure. We've learned how to connect swing points to know if price is trending up or down or consolidating. We've talked about how being able to do these things allows us to spot shifts in delivery, changes in market conditions, and build a clear path for what price is likely to do next. So the recap is we've been able to identify trends and master the relationship between swing points and understanding what price is doing. So if you can master these relationships between the swing points, you'll be able to read the market structure with confidence. So I want to thank you for taking the time to read this book. My goal wasn't to teach you a strategy. My goal was just to teach you how to read price. If you understand swing points, swing lows, market conditions, swing highs, and market structure shifts, you're going to have the foundation that can be applied to any market, any time frame, any trading model. So master the basics first. The traders who stay in the game the longest aren't the ones chasing indicators or shortcuts. They're the traders who understand how price moves. So keep studying, keep journaling, keep improving. I'll see you in the charts. If you want to connect with me, you have my YouTube channel, Good Eats FX. You have my link tree for mentorship and resources. I'm on X, Twitter, and you can email me here. My final takeaway is if you can identify swing points, you can identify the market structure. If you can identify market structure, you can understand market conditions. And if you can understand market conditions, you'll stop guessing and start reading price. Signing off, Devotedpips. Peace.